I need some money.
Dude, you never pay your debts. I'm not letting you borrow any money.
You can have my mother if I don't pay. What's that for?
Your kidneys are worth more. In the example above, the kidney would be considered collateral. Collateral is anything of value that you own that is worth at least as much as what you want to borrow. Loans that require collateral are called secured or recourse loans because if you fail to pay, there's still another way that the lender can recover their money. Loans that don't require collateral are called unsecured or non-recourse loans, because if you fail to pay, there's very little a lender can do to recover their money. Secured loans are much easier to obtain than unsecured loans. If you lack funds, then having things that are worth something makes it easier for you to get a loan. Pawn shops are built around this idea. You need money, you hand over something worth a lot of money, and they give you a fraction of it. And if you don't repay them in the time specified, they sell it for whatever they can get, in the hopes of recovering the amount that you borrowed. So how can you increase the value of the things that you do own? Well, the most obvious answer is to not buy anything that is guaranteed to go down in value. These include cars, clothes, electronics, food. Have you ever seen anyone trying to sell used pizza? These are things that may cost a lot when new, but as soon as they are used, they are worth less. Collectibles like certain sneakers or handbags are the exception and generally identified as collectibles years after they've been released. So short of things that have a high probability historically of going up in value, stocks, collectibles, art, property, precious metals. What else can you do? Well, a big factor in what something is worth is its condition. Let's say you got a pair of original Jordans signed by the man himself. According to Sotheby's, those are worth around $500,000. And in a crunch, if you needed some cash, you could either sell them or take them to a pawn shop and get some money for it. And if you managed to repay that debt, you'd even get them back. But only if the last person to wear them was Michael Jordan. If you were to wear them and then play a pickup game for the next 10 years, leaving them torn up and stepped on and, is that dog poop? Well, let's just say they'd be worth less than $500,000. One could even say they'd be worthless. But bruh, that's like obviously a collectible, not normal everyday items. Not true, the whole couch flipping industry is based around this. If used furniture for sale in good condition was just the same as used furniture for sale in bad condition, they'd both have the same price. Instead, we see that used furniture in good condition sells for much higher than furniture in bad condition. The same goes for houses. A fixer-upper sells for a lot less than the exact same house after it's been fixed up. The entire house flipping industry is based around this idea. Prices are set by supply and demand. And there's greater demand for things that are in good condition versus bad condition. That's why the better the condition something is in, the more it is worth. But how do lenders decide how much something is worth? Well, pretty much how you would decide something is worth. They compare prices of similar items that have already sold. For example, why do we say $3,000 for a dozen eggs is expensive and $3,000 for a used car is cheap? The issue isn't the price, but what similar things are going for. If they cost more than similar items, it's expensive. If they cost less than similar items, it's cheap. So how can you use this to get approved for a loan? First, consider what you buy before you buy it. There are some things that have a high probability of going down in price the minute you buy it, such as cars, electronics, clothing. Spending a lot of money on those items rarely results in it maintaining the same price you paid for it. Forget about it going up in value. In those cases, maybe it's better to just buy something that doesn't cost a lot in the first place because there's only so much it can fall until it hits zero. Expensive items have a bigger distance to fall and represent a greater loss. Second, do your best to take care of it, no matter how much it costs. Ensuring it stays in good condition will ensure its resale value will be higher, even if you opt for the more expensive item. There's a reason when normal people sell old stuff, it's called a garage sale, and when rich people sell old stuff, it's called an estate sale. Loans that require collateral are called secured or recourse loans because if you fail to pay, there's another way they can still recover their money. Loans that don't require collateral are called unsecured or non-recourse loans because if you fail to pay, there's very little they can do to recover their money. Secured loans are much easier to obtain than unsecured loans. In fact, in a coming video, I will discuss how to use secured loans to build your credit history when you have none. So if you have no credit history, then it's a good idea to have things that you can use as collateral to start building your history of borrowing and repaying money. And this will convince lenders to lend you larger amounts of money. Start small and grow big over time. And the larger the loan, the more important collateral becomes. When borrowing money to buy a home, the home itself becomes collateral in case you fail to make your mortgage payments on time. And because home prices typically tend to go up over time, it's a safe bet, unlike a car which typically only ever goes down in value.